Hello and welcome to US Report, a four-part series from Barnett Ravenscroft Wealth Management. We'll be looking at the state of the world's largest economy and asking, how should investors be positioning their portfolios in preparation for the year ahead? "2011 was a turbulent year for world stock markets. There were fears over the lack of growth in the West, over the stability of banks and even entire nations, and also the possibility that the euro might collapse. But since the turn of the year, there have been more encouraging signs. We've been all over this vast country to speak to investment experts about what they make of it all. Traditionally, January is the time when so-called market experts make their predictions. But how much notice should we take of them?
Well, different experts are favoring different stocks, and or else the stocks that are favored by everybody would have already gone up in price enough. So it's definitely, pick your publication, pick your expert.
I don't think there's really any value in these short-term predictions, and I understand that it sells newspapers and magazines and it attracts people to watch, the financial media. We're all interested in these kinds of things. It's kind of like believing in Santa Claus. You want to believe that there's a way to beat the market and someone can actually forecast these things. But I think the preponderance of the evidence is that it's not useful.
The general consensus is that after a dismal decade, equities are due a better run.
But most of the bad news that's out there has been out there for several years. There's very little new bad news. We don't get into the forecasting business, but nevertheless, sometimes you do look at overall valuations of the market. Are prices high or low relative to some notion of book value or earnings or whatever? And any of those measures, the markets look fairly priced.
Recent economic data suggests that US recovery is on track, and where America leads, other economies often follow. But this experienced analyst of stock market performance says it's a mistake to assume that economic growth will automatically mean higher market returns.
I find a pervasive belief among investors and in the news media that there's a very close relation between economic growth rates in any particular country and the stock market return. And yet when you look at it on a more rigorous basis, you find this relation is tenuous at best. Markets often do the best when the economic numbers are mediocre to poor, and conversely, they often do worse when the economic numbers are just fine.
There is a theory that stock market gains early in January, like those seen this new year, augur well for the year as a whole. But Weston Wellington urges investors to ignore it.
Much as I would like to believe that will apply for this year, I have to remind myself that last year the January indicator was quite positive, and it turned out to be a treacherous year, a difficult year at best.
And what of the theory that shares do well in a presidential election year?
I would have a similar response. There's just enough evidence to keep people interested, but it's not a practical, useful rule.
In America, as in the UK, many investors are so worried about the possibility of further economic shocks, another credit crunch or the collapse of the euro, for example, that they're steering clear of equities altogether. But all the experts we spoke to said that's a mistake.
There aren't very many benefits to living into your 70s, but one of them is that you've seen all kinds of horrible things described as going to happen any day now. And honestly, they keep coming. But it's a little bit like, do the Red Sox beat the Yankees, or does Manchester United win every game? It's interesting, it's fun, but honest to goodness, if you took a string of the different bits and pieces and said, can you tell me what year this was? It might be very difficult.
What I expect happens in the market is in turbulent times like this, when people want to be pulling back, in recession times like this, when people want to be spending out of their savings, in order to induce people to save, in order to induce people to bear all of this uncertainty, expected returns almost certainly have to go up.
With globalisation now in full swing, many investors are increasingly focusing on emerging markets. But all our experts advised against neglecting more established economies like the US, Europe and the UK.
If you went back to the 1880s, late 19th century, the leading economic power was the UK, and sort of the emerging market, the China of that period, if you will, was the United States. And most people would say, you get to the 20th century, the United States economic growth was greater than that of the UK, greater than that of Europe in general. And if you were to ask somebody about equity returns, most people would say the US equity market outperformed the UK equity market because of that more rapid growth. And actually, it's not true. The UK and the US had almost identical equity returns for the 20th century. And the reason for that is British companies became much more global in their approach and actually took advantage of the faster growth that was occurring in the United States and other parts of the world. So I think it's very important for investors to have a global perspective, and they should really think of trying to get equity exposure to all markets.